Since the US Federal Reserve hiked rates by 75 basis points last Wednesday, the Sensex and the Nifty 50 indices have tumbled nearly 4% each, turning negative in terms of returns for 2022. As per technical charts, over half of the Nifty 500 index constituents have been dragged below their respective 200-day moving averages with the recent sell-off. Technically, the 200 DMA provides a broad outlook of the underlying trend in a stock or an index for long-term investors. Traders prefer stocks and indices that are above the 200 DMA since they tend to perform better over time. Analysts, however, say this correction has been overblown due to panic selling by investors.
In Indian market, it is over there, certainly, because this is what happened last 3 times. Whenever there was a pain in the global market, whether it was a dot-com originated there, then Lehman crisis originated there, deflationary conditions early 2016, Jan, February originated in the Western world, COVID also originated outside India. So all 3-4 occasions, Indian market was also penalized a lot, and then Indian market bounced back a lot. And in all 4 conditions, one thing was very clear: the India GDP growth never got into negative territory. Most importantly, with the latest hike in the interest rate in the US Fed, US also crossed, around 65% of the targeted interest rate hike. So again, the lot of data point prove, even for US market, that just 1 or 2 months before the Fed rate peaks out, the markets start rising, and markets have given a phenomenal return even in the US. So I am pretty confident that with the good monsoon, decent Kharif output, because a double-digit deficit was there in Kharif area. As of today, it is just 1.6%. And tax collections, oil price crash, all this would augur well.
Sharing similar views, VK Vijay Kumar of Geojit Financial Services says, despite an unfavorable global macro construct, in the short run, the Indian markets will outperform their global peers. Vijay Kumar says, with the Fed staying ultra-hawkish, the 5% slide in the MSCI World Index last week reflects the bearish undertone of global equities. However, India will outperform both in economic growth and market performance. Selective buying can be done in domestic economy-facing segments like financials, auto, capital goods, and others. That said, the Sensex and Nifty indices slid below their 50-day moving averages on Monday, and the duo can continue the slide on breaching the key support levels of 200-day moving averages, as per technical charts.
After holding the selling spree at 50 days moving average last week, the Indian benchmark indices further declined on Monday, negating that support. BSE Sensex and Nifty were seen trading 1% lower and continued their 4th losing streak. At this point of time, the next support for Sensex and Nifty comes at 200 days moving average. For Sensex, 57,000 and for Nifty, 17,000 are the 200 days moving average. And with the selling pressure on Monday, we have seen altogether 268 stocks losing their ground below 200 days moving average. 37 stocks were added on Monday itself. And both the indices loses ground below their 200 days moving average. Sensex could fall to 56,000, whereas Nifty can slip to 16,700 to 16,800 levels. Among Nifty 50 stocks, we have seen HDFC Majors, HDFC Bank, HDFC and Reliance, as well as PPCL losing further ground. Among Sensex stocks, Power Grid, TCS, Wipro, Tata Steel were losing their ground below 200 days moving average.
Today, global market trends, FII inflows, rupee dollar levels and oil prices will dictate the market trajectory.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.